While everyone was panicking about silver dropping on Friday, something happened in South Korea that changes everything. Samsung just confirmed the specs for their new solid-state battery production line. 900-mile range, 9-minute charging. It sounds incredible, right? But they left out one critical detail. The detail Wall Street hasn't priced in. The detail that makes the current silver shortage look like a rounding error. The secret ingredient isn't lithium, it isn't cobalt, it's silver. And not just a trace amount. We're talking about a massive structural increase in silver consumption for every single vehicle. By the end of this video, you'll understand why the recent silver price drop isn't a crash. It's the last discount you might ever see. For the last 30 years, we've run on lithium-ion batteries. Your phone, your laptop, your EV, all use liquid electrolyte lithium-ion technology. They're great batteries, but they have one fatal flaw: dendrites. When you charge a lithium battery too fast or cycle it too many times, lithium ions form these tiny needle-like crystals called dendrites. They grow like jagged roots inside the battery. Eventually, they pierce the separator between the anode and the cathode. And when that happens, short circuit, thermal runaway, fire. This is why EVs can take 45 minutes to charge. You have to charge them slowly to prevent dendrites from forming. This is why they can catch fire. This is why their range drops in the winter. The holy grail of battery tech has always been the solid-state battery. No liquid, so no fire risk. Instant charging. Double the range. Toyota, Volkswagen, every major player has promised this for a decade. But they all failed. Why? Because no one could stop those dendrites from forming on the anode. Graphite anodes didn't work. Silicon anodes expanded too much. And pure lithium metal anodes were just too unstable. Then, researchers at Samsung SD, I found the solution. They discovered one specific element, when applied as a nanocomposite layer, completely solved the problem. It lets lithium ions move freely, but stops dendrites cold. That element is silver. Specifically, a silver-carbon nanocomposite layer. Now, this isn't a theory. This is published science. Samsung's prototype cells use a thin layer of silver mixed with carbon to regulate how lithium is deposited. The silver acts as a host for the lithium ions, dissolving them evenly across the surface and preventing those dangerous spikes from forming. And here's where it gets absolutely crazy. Right now, a standard gasoline car uses about 15 to 20 grams of silver for things like window switches, seat motors, and defrosters. A typical electric vehicle uses a bit more, around 30 to 50 grams, for its inverters, battery management systems, and high-voltage cables. But solid-state batteries change this math completely. We're not talking about a few switches anymore. We're talking about coating the entire anode of every single cell in a 1,000-pound battery pack. Early estimates from Samsung's own research papers suggest 5 to 10 grams of silver per kilogram of anode material. So a conservative estimate puts it at about 50 grams of silver per vehicle. But for the high-performance packs, we could be looking at 200 to 500 grams of silver per car. Let's just run the numbers. Around 90 million cars are produced globally every year. If just 10% of those switch to solid-state batteries, that's 9 million cars. At an average of 100 grams of silver per car, that's 29 million ounces of new annual silver demand. That sounds manageable, maybe. But now let's scale it. What if adoption hits 50% by 2028 and the average silver loading is 200 grams? We're suddenly looking at 115 million ounces of new demand. That's more than Peru's entire annual production. It's like another solar industry appearing overnight. Here's the problem. The total global mine supply for silver is about 830 million ounces per year. And current demand already exceeds supply by 50 to 100 million ounces annually. We are already burning through reserves just to keep the lights on. Now, add 115 million ounces for solid-state batteries. Where is it going to come from? The COMEX, the main futures exchange, only has about 30 million ounces in its registered inventory. Mining output is flat. Ore grades have collapsed from 15 ounces per ton back in 2005 to just 4 ounces per ton today. And recycling won't save us. Gold is recycled at a 90% rate. Silver? Less than 20%. Why? Dispersion. Silver is sprinkled in microscopic amounts across billions of devices. It costs more to extract than it's worth, so it just ends up in landfills. Even if we could recycle these new batteries, the silver that goes into a 2026 model is locked away until 2041. It has removed from the available supply for a generation. This creates an extinction equation. Total supply is less than the demand from solar, plus electronics, plus the new solid-state batteries. Industrial demand alone threatens to consume 100% of all mine supply. So why aren't you hearing about this on the news? Why is the financial media talking about a lithium oversupply, but ignoring the silver squeeze? Because the narrative hasn't caught up to the science in the lab. Wall Street analysts are lazy. They're looking at spreadsheets from 2020. They assume EVs just equal lithium plus nickel. They treat silver as a legacy metal for mirrors and spoons. They don't read Samsung SDI technical white papers. They don't look at the patent filings from other battery companies like QuantumScape and Toyota. If they did, they'd see the element symbol AG appearing over and over again. This information asymmetry is your edge. Right now, the market is mispricing silver because it thinks demand will grow at 2% per year. It doesn't see the step function change that solid-state batteries represent. We saw the exact same thing happen with palladium in the early 2000s. Automakers switched to palladium for catalytic converters. Nobody paid attention. Then, demand exploded. Palladium went from $200 an ounce to $3,000. The analysts were 10 years late. We are seeing the exact same setup with silver right now. So, how do you position yourself for this? I see 3 lanes. Lane 1, physical metal. But forget collectible coins. When Samsung needs silver for batteries, they don't care if it has Darth Vader on it. They need raw silver to melt into nanopowder. In a true industrial squeeze, the high premiums on collectibles can collapse. The strategy? Stop paying for art and start paying for weight. 100-ounce bars, 10-ounce bars, government-minted bullion. Maximize your grams of silver before Samsung tries to clear the shelf. Lane 2, mining stocks. This is where life-changing wealth can be made if you pick the right ones. The trap to avoid? Hedged miners. If a company has already locked in its future sales at $30 an ounce, they completely miss the rally. You want 100% unhedged exposure to the spot price. And you want primary silver miners, not companies that get silver as a byproduct. When silver hits $100, unhedged miners can see their profits explode 8 to 10-fold. Lane 3. Geography matters. US and EU laws require battery materials to come from friendly nations to qualify for EV tax credits. A mine in Nevada is worth 5 times more to Tesla than a mine in Bolivia, even if the ore is identical. Why? Security and political stability. So tilt your focus toward Tier 1 jurisdictions. Canada, the USA, and Australia. We're currently in the weekend gap. The price is frozen from Friday's close. But the news about Samsung is circulating. When the Asian markets open on Sunday night, watch the Shanghai Gold Exchange Premium. Unlike the COMEX, which is a paper casino, Shanghai is all about physical delivery. Right now, there's a massive disconnect. Silver sold in New York for $61.50, while it was being bid on in Shanghai for $66, $67. That's a risk-free $5 arbitrage. Global traders will exploit this. They'll buy COMEX contracts and immediately sell them in Shanghai. This creates massive buying pressure that forces the price gap to close. I predict that on Sunday night, we'll see a violent gap up. It could jump instantly to $63 or $64. If that happens, the Friday smash gets negated instantly. The banks who went short on Friday will be underwater by Sunday dinner. This sets the stage for a short squeeze on Monday morning. The coming week will be brutal, not because of fundamentals, but for your emotions. The banks know they're in trouble. Their only weapon left is volatility. You'll see $3 swings daily. They want to induce motion sickness. They want you stressed enough to hit that sell button just to get some sleep at night. Do not fall for it. Does a $3 drop change the chemistry of solid-state batteries? No. Does a margin hike change the fact that Samsung needs 100 million ounces of silver? No. The fundamentals are inelastic. The price volatility is just noise. So detach from the daily ticker. Instead, look at the premiums. If the spot price drops, but dealers are still charging $80 for a coin, the drop is fake. Look at inventory. If the spot price drops, but out-of-stock banners are still up everywhere, the drop is fake. The paper price will be weaponized against you. But physical reality is your shield. Samsung just detonated a silver bomb in their R&D labs. The shockwave is going to hit the price chart very soon. Friday's drop wasn't a crash. It was your last chance to front-run one of the biggest industrial shifts in history. The banks are playing a paper game. Samsung is playing a physics game. And physics always wins. Thanks for watching. If you found this valuable, please like and subscribe for more updates.